Hey everyone, and welcome back to the channel. I'm Steve, your teacher for all things finance, here to cut through the noise and show you how money really works. If you're ready to learn how the wealthy truly build their fortunes, do me a favor right now. Hit that like button, leave a comment below with your biggest fear about a recession, and make sure you're subscribed so you never miss a lesson on mastering your money. Have you ever noticed how every time the economy falls apart, the people at the top somehow come out even richer? It happened in 2008 when investors bought real estate for pennies compared to what it used to cost. It happened in 2020 while regular people were worried about paying their bills, but the wealthy were quietly adding millions to their net worth. It almost feels unfair, like the whole system is built, so some people always win and everyone else just tries to survive. But the truth is, it's not rigged in the way most people think. Wealthy people aren't simply lucky, and they're not getting rich by cheating the system. They just understand something about recessions that most people never learn. And once you understand it, you can start taking advantage of the exact same opportunities. On my channel, I try to talk about how money really works. Not the flashy social media version, but the real version most people never see. And today, I want to explain why recessions, as scary as they feel, are often the best wealth-building moments you'll ever get in your lifetime. Think about how most people react when they hear the word recession. The instinct is fear. Pull back. Save every penny. Stop spending. Definitely stop investing. Just hold on and hope things go back to normal. It's completely understandable, and honestly, it's what almost everyone does. But that reaction is exactly why most people never build wealth. Because while the majority sees danger, the wealthy see something completely different. They see a giant sale. Imagine your favorite store suddenly announcing a massive clearance event where everything is 70% off. You wouldn't think, wow, this store must be struggling, I should stay away. No, you'd be there early, credit card in hand, and excited to get things you could never afford at full price. But when the entire economy goes on sale, like when stocks drop, when real estate gets cheaper, when great businesses suddenly cost half of what they used to, most people panic and run away. Wealthy people walk right in. The interesting thing is, you don't need a giant pile of cash to take advantage of this. What you really need is a different way of thinking. Wealthy people have something I like to call the crisis discount. During normal times, everything is priced at or above what it's worth because everyone is competing to buy. But in a downturn, fear takes over. People sell things not because they want to, but because they're scared or they need cash immediately. And when people sell out of fear, they sell for far less than something is actually worth. That's why a house worth $500,000 might suddenly sell for $300,000. The house didn't suddenly become worse. The seller just needed out. Or a solid company might lose 60% of its stock value overnight. Not because the company is bad, but because investors are terrified and want to escape. These moments are, without exaggeration, some of the greatest opportunities of a lifetime. But here's where things get even more interesting. Wealthy people can take advantage of these moments because they keep something most people don't: liquidity. Basically, they keep some money available. Not all of it invested, not all of it tied up. Enough that when the economy dips, they're not forced to sell anything. They're able to buy when others are dumping their assets out of panic. Most people don't do this. When the economy is booming, they put every dollar into something. Stocks, crypto, real estate, whatever is hot. Cash feels like it's just sitting there doing nothing. They hate the idea of lazy money. They're chasing maximum growth in the short term, forgetting that the market is cyclical. This is a crucial distinction. During a bull market, cash feels like a drag. During a bear market, cash is king. Think of it like this. Your cash is an option on future assets. When assets are cheap, that option becomes incredibly valuable. But then the recession hits, their investments lose value, emergencies happen, maybe they lose their job, and suddenly they need cash now. And that forces them to sell at the worst possible moment, locking in losses and missing the recovery. Meanwhile, the wealthy have cash on the sidelines. They weren't trying to squeeze out every drop of growth during the good years. They were preparing for the moment when everything would go on sale. And when that moment comes, they're not scrambling, they're shopping. The concept of liquidity extends beyond a simple emergency fund. It's about designing your entire financial structure to be anti-fragile. It means having enough stable, low-risk capital to not only cover every possible worst-case scenario, but also to capitalize on it. This is why many financially literate individuals intentionally kept a significant portion of their net worth in cash or near cash equivalents throughout 2018 and 2019. They weren't betting against the market, they were simply preparing to buy the dip with capital that wasn't already tied up. Let's look at a concrete historical example. During the 2008 financial crisis, while millions of homeowners were defaulting and banks were seizing properties, sophisticated real estate investors, backed by liquid funds, were able to acquire massive portfolios of single-family homes at cents on the dollar. They weren't buying with their retirement accounts. They were using available capital to secure assets that would appreciate tenfold over the next decade. Their preparation in the years leading up to the crisis was what enabled their purchases during the crisis. Another huge difference between wealthy people and everyone else is how they build their income. Most people have one source, their job. That's it. If that paycheck stops, everything becomes a crisis. But wealthy people set up multiple income streams. It might be a rental property, dividends from stocks, a small business, royalties, online income. It doesn't matter what the mix is. What matters is that if one stream slows down, they still have money coming in from other places. And during a recession, when everything becomes cheaper, they often use that moment to add even more income streams. Think about two people with the same job and the same salary. One loses their job in a recession and immediately goes into panic mode because it's their only source of income. The other one loses their job too, but still has a rental property, dividend checks, and savings. That second person has time, options, patience. Instead of taking the first job that shows up, they can wait for the right one and even pick up discounted investments while prices are low. They come out of the recession stronger than they went in. It's important to recognize that recessions don't just create investment opportunities. They create entrepreneurial ones. When big companies lay off talented workers, the cost of skilled labor temporarily drops. When consumer behavior shifts, it creates a need for new, cost-effective solutions. Many huge, successful companies were founded during deep economic downturns. Think of General Motors, founded during the Panic of 1907. Or Uber and Airbnb, founded right after the 2008 crash. The pressure of a recession forces people to be leaner, more innovative, and more focused on solving genuine problems instead of simply chasing trends. For the financially prepared, this is the perfect time to start a business with a lower overhead and less competition. And this brings me to something really important: knowledge. Most people were never taught how money works. They know how to earn it. They know how to spend it. Maybe they know how to save it, but understanding assets, understanding cash flow, understanding how to evaluate whether something is actually a good deal, almost nobody learns that unless they go out of their way to study it. During good economic times, this lack of financial knowledge doesn't hurt much because the rising tide lifts everyone. Even bad investments tend to go up. But when a recession hits, that lack of knowledge becomes dangerous. People see prices falling and can't tell whether something is undervalued or whether it's genuinely in trouble. They follow headlines, they follow fear. They make emotional decisions instead of informed ones. Wealthy people, on the other hand, have spent years learning. They know what to look for. They understand cycles. They understand value. When a recession hits, they're not trying to figure things out in the middle of the chaos. They already have a plan. The difference between successful and unsuccessful recession navigation often boils down to a single question: can you separate the asset from the emotion? Most people attach their self-worth to the current value of their portfolio. When they see a number drop by 30%, they feel 30% poorer and 100% terrified. This emotional distress is what drives them to sell, turning a temporary paper loss into a permanent, actual loss. This is what we call the emotional tax of investing. Wealthy people understand that the price of an asset today has little to do with its inherent value over the next decade. If they buy shares in a solid company for $100 and it drops to $50, they don't see a loss. They see a discount on an asset they already believed in. They mentally classify the drop not as a failure, but as a temporary market inefficiency. They practice radical detachment from the day-to-day volatility. This psychological strength is arguably the most valuable financial asset you can possess. And all of this leads to something that I think might be the most overlooked factor of all: patience. Wealthy people can afford to wait. They're not looking for a quick win next week or next month. When they buy during a recession, they know things might get worse before they get better. They know the recovery might take a year or two, but they're not pressured to sell early. They're not emotionally rattled by temporary drops. They hold on long enough to see their investments climb, not only back to where they were, but beyond. Most people don't have the luxury of patience because their financial life is stretched too thin. Even when they buy something at a good price, they end up selling too soon, either out of fear or out of necessity. Wealthy people stay calm. They buy more when prices drop further. They let everything play out over years, not weeks. And when the recovery comes, which it always does, that patience pays off massively. Let's put this into perspective using history. If you had invested in the S&P 500 at the very peak just before the Great Depression, you would have endured a decade-long struggle. But if you were patient, by the 1940s, you would have recovered. Now, consider a more recent example, the 2008 to 2009 low point. If you had the courage and liquidity to invest in March 2009, you would have seen a phenomenal return over the next 10 years, riding one of the longest bull markets in history. The key wasn't timing the bottom, it was having the patience to hold from a low point until the eventual, inevitable peak. Wealthy people have a longer time horizon, often thinking in terms of decades, not quarters. They are not trying to get rich this year, they are building permanent wealth that compounds over a lifetime. Here's the part nobody likes to say out loud. Everything I just described isn't really about recessions. It's about mindset and structure. Most people see money as something scarce that needs to be protected. Wealthy people see money as a tool, something that grows when used correctly. They're not fearless. They've just been through enough cycles to know that downturns don't last forever, and that opportunity hides inside every moment of fear. And here's the best part. You don't need to be rich to start thinking this way. You don't need a trust fund or some magical advantage. You just need to start small. Build a little emergency fund. Learn a bit about investing. Add a second income stream, even if it's tiny at first. Practice staying calm when markets dip instead of reacting emotionally. These small steps compound over time. Your first recession might feel overwhelming. Your second one will feel more manageable. And by the third, you'll start to recognize patterns. You'll start to see opportunities instead of threats. And one day, you might find yourself grateful for a downturn. Not because you want people to struggle, but because you finally understand how to navigate the chaos instead of being crushed by it. Another downturn is coming eventually. Nobody knows when, but it's inevitable. And when it does, wealth will move. From the people who panic to the people who are prepared. The only real question is which side of that transfer you want to be on. If this video helped change your perspective on market crashes, make sure to hit that like button and tell me in the comments one thing you're going to change about your finances today. Don't forget to subscribe for more practical, no-nonsense financial lessons. Thanks for watching, and I'll see you in the next video.